Peter, thanks very much for agreeing to do the interview. I thought mainly we could cover U.S. stocks, and if we've got time, we'll have a look at the Nikkei as well.
Okay.
But I thought maybe we could start. This broadening top pattern that we're looking at the moment in the S&P, I know you can see a similar pattern in some of the other U.S. indices like the Wilshire and the Dow. The same pattern reoccurs, doesn't it? And
yes.
Looking at this is what a 15-year chart. The first thing I wanted to ask you was that has that upper trend line actually been breached in a meaningful way?
Okay. All right. Yeah. Let me go into this pattern here. We've gone back to about 1900 on the S&P 500, or the start of trading on the S&P 500 in the early 1900s, and we try to look for a similar type of formation over the last 100 plus years or so, and this is the first time we've seen S&P generate a potential broadening top formation. Either this is one of the biggest broadening top formation we've seen, or this is a false signal. So we're looking into it, and we're studying this formation a little bit more carefully here. It could very well be a failed breakout, and that's where we're monitoring this 1600, 1700 zone area, because the upper end of that broadening top formation converges very, very closely to 1600. But typically, there could be a false breakout, meaning that we could rally to 1700 or slightly higher and then reverse direction and fall back below the 1600, and that would negate this broadening out top formation. If that happens, then there's another pattern showing up, and we call that pattern a complex head and shoulder bottom pattern. And if you take a look at the emerging market debt crisis, that could be the left shoulder, and then obviously the tech and telecom bubble burst into 2002, 2003 could be a second left shoulder, and obviously the financial crisis of 2007 to 2009 fell off when the S&P went down 57+%. That 666.79 low on the S&P cash market could very well be the head formation, where 2010, 2011, we have midterm elections in 2010. We hover along that 1010, 1040 zone area. That may very well be a right shoulder. Now, very, very difficult call right now, and we believe these long-term calls takes time to develop. So we're not going to know right away. We suspect the second half of 2013 is going to be very, very crucial. Either we have the beginning of a breakout situation, which is what the bulls are alluding to, that we're going into the next structural bull market, or this is a top in the cycle. If it's a top in the cycle, then we will probably head down into the 1100 zone area, where we may have to establish the right shoulder to this head and shoulder bottom pattern.
Okay. Typically, our broadening tops are obviously a reversal pattern. They don't act as continuation patterns, do they?
Yes.
That broadening shape.
Yeah.
So how will we know whether it is a false breakout? What will confirm whether it's a genuine breakout?
One of the things that typically happens off of such a major rally from the 2009, we're up over 150%. This is one of the biggest rally we've seen, even bigger and larger than what we saw in the 2002 to 2007 tech recovery. In that pattern there, or in that move up, it took 5 years for the S&P to get back up, 110%, 115% or so, and we're already up 150% going to 4+ year into this rally. Now, the question that's really difficult is in 2000 and in 2007, there was ample warning that we were reaching a major peak in the cycle. And there was something called negative outside month reversal pattern that was quite evident in 2000. There was 3 of these negative outside month patterns starting in January and then July and so forth. And in 2007, ahead of the financial crisis there and the subprime blow up there, we saw 2 negative outside month patterns in 2007. So we may get another one of these negative outside month patterns. If that shows up, then that would signal some kind of a top in that market. Could be a blow-off top. We're not quite sure yet that we may enter into a blow-off top, which means we could get some kind of island reversal or some kind of like a dramatic 5, 6, 7% drop in one day that will scare investors and put everyone into risk aversion mode. So it's a complicated situation right now, but because these patterns are nearly, 15 years or so, we have to give it a little bit more time. My sense here is we have to pay particular attention to the back half of this year. There's going to be a lot of convergence in cycles, and indicators are all converging into the back half of 2013.
Okay. Am I right, Peter, in saying that in your recent kind of long-term research report, you attached about a 60% probability to actually this broadening top, the price is bouncing off the upper trend line and then falling towards a lower trend line. So we're going to have potentially a large fall in the stock market over the next kind of 18 months or so. You kind of suggested this is kind of more likely than not to happen. Is that true?
The probability here is 60%, which is relatively high, that we will enter either into a very deep correction over the course of the next 6 months to 2-year window. That's the window we're watching for, or we go into what was commonly referred to as a cyclical bear decline. So our interpretation of the market right now is that we may be entering into the mature phase of this March 2009 cyclical bull rally, which differs from a lot of the bulls on the street which are claiming that we're entering into a structural bull market. So now the timing of this call is very, very tricky right now because of the monthly chart formation. But a 60% probability is relatively high that we either are going to enter into a deep correction, which is typically defined as 10 to 20% drop. Bear market or cyclical bear decline is typically in excess of 20 to 30% drop. There is a possibility that these 10-month and 30-month moving averages are going to hold a key behind whether the market is entering into a corrective mode or deep correction or a cyclical bear decline. If you take a look in 2000, 2001, 2002, look at the rolling of these 10-month and 30-month moving averages. They were very, very strong signals suggesting that the market is peaking out. Both times we had both moving averages broken. The 10-month moving average broke first in 2000, and then we saw the breaking of the red moving average, which is the 30-month, also in early 2001. We saw the same thing happen in 2007, late 2007. We breached the 10-month moving average, and then subsequently during the first quarter of 2008, we broke through the red line, which is the 30-month moving average. So we're not quite there. That's why I'm saying that it's going to take some time, maybe 6 months, maybe 2 years, to develop further.
Okay, but we do have a potential price target here of about 600 or so for the S&P, don't we? It's a worst-case scenario.
If this is a legit broadening top formation, the bottom of that connection of the 90, 97, 98 lows versus 2002 and then 2009, if you extend that, it looks like it's converging very, very close to 600. To get it down that low, you really have to have either a major tail risk event or geopolitical event or macro event to force upon global risk aversion. In other words, you have to sustain another 2000, 2002 or 2007, 2009 sell-off where investors went into risk aversion.
Looking at the shorter term, Peter, has the recent sell-off over the last kind of week or 10 days, does that have any significance, do you think? or was this just is that just profit taking and a natural correction?
It's a very choppy environment over the last few weeks or so, because if you take a look at the two charts here, the middle chart is the 4-year channel, uptrend channel formation on the S&P 500. That has kept many of the bulls in the market because it's well defined here. What I'm watching carefully here is that we have hit the upper end of that channel near the 1700 zone area, give or take 10 points or so. And once we hit that level, we also generated, I think it was May 22nd, we generated a negative outside day pattern, which is a negative distribution type of formation here. And since then, we've fallen about, 5.2, 5.3%. But if you take a look at the chart there, on the third chart, there was a trend line going back to November, December of last year, and that trend line is right about that 1600 where we fell right to, and it seems that the bulls are defending the market right now. They're coming in here and buying the market off of the 1600 area, and we also have generated a positive outside day pattern just yesterday off of that reversal. So it is a possibility that we may enter the end of the quarter in some kind of trading range. Maybe the next 2 weeks, 4 weeks, 6 weeks or so, we go into a high-level trading range between 1600 plus or minus 10 points and 1700 on the upside. And it could be confusing because these type of volatility is going to scare a lot of the retail investors out of the market, and the professionals are driving this market. Hedge funds, money managers are playing this market, and they're going to create some volatility in the market into the end of the quarter, into the early summer months.
Okay, and obviously we've been looking at trend lines and so forth. Are there any moving averages or oscillators? What are they saying? Are they basically supporting what you've just said at the moment?
The market breadth indicators are okay, and what we found very interesting is the market breadth indicators diverged back in 2007 and also into the 2000 rally. Both times the market breadth came down and did not confirm the rising stock prices. This time around, we're not yet picking up a significant divergence in the market internals. We are noting that a number of our overbought, oversold indicators are flashing. Percentage of stocks trading above the intermediate-term moving average, the 30-week moving average for the S&P 500 stocks are near extreme readings. Some of the sentiment indicators, the AAII surveys, the Investors Intelligence surveys, they're at heightened levels, but not quite yet at extreme readings. So we're monitoring to see if the next rally up, possibly where we move slightly above the 1700 range area, could force upon sideline money into the market, and maybe we generate some kind of reversal pattern off of that next move up. That could signal some kind of peak in the cycle. But again, a little bit too early to tell right now as to whether we can push through 1700, since that level seems to be a very significant resistance zone area. Okay,
and what's going on at the moment with the U.S. Treasury market and so forth? Is that having a significant impact on the stock market? I mean, I know we're talking technically, but is that something that you look at as well?
Yes. We believe that the U.S. Treasuries, in particular the benchmark 10-year Treasury, as well as we closely monitor the 30-year Treasury, even though most money managers don't follow the 30-year as closely as the 10-year, but the 30-year is long duration, and it's very sensitive to these economic cycles. So we sort of recognize that the bond market is somewhat of a leading indicator of business cycles, and as a result, it's also a reflection of risk-averse or risk-seeking trades. So if investors are taking risks, they'll come out of the bond market and then move themselves into higher beta areas, typically stocks. And vice versa. If they come out of the stock market, they typically will hide in the safety or of the Treasury, in particular the 10-year and 30-year Treasury. Now, we believe we're headed into an inflection point on the 10-year Treasury yield. So we're watching very carefully this 2.25 to 2.41 area. Very, very important levels that will signal to us either we are peaking in that cycle here, or we're going to move higher in interest rate. So a convincing move through 2.25, 2.41 would confirm some kind of technical breakout, and yields could rise upwards into the high 2%, low 3% level, 2.75, 3.25, somewhere upwards towards those levels, and that could hurt the equities market, especially some of the interest rate sensitive sectors, which has been coming under pressure. A lot of the REITs, the MLPs, the utility stocks, in particular electric utilities, have been coming under pressure and they've been falling very, very dramatically, some of the high dividend yielding stocks, since they compete for funding between income investors. So we're monitoring this call on the pullback. 1.8, 1.9% on the 10-year Treasury seems to be a key level. We suspect we're going to come back down to 1.8, 1.9, given the extent of this rally from 1.6 straight up to this 2.25. So 1.8, 1.9, watch that level. Could be a very significant test. If we fall below that level, then yields are going to back off probably to 1.6. But we are sensing that if the stock market begins to peak out, risk aversion trade is going to head to the bond market once again. And there is a long-term study that we ran on a linear regression, 2 standard deviation band, and it does allude to the fact that if we have a crisis and if the stock market reaches a blow-off stage to this rally and begins to reverse direction, investors are going to high in the safety of Treasury, which could theoretically bring us back down to the lower end of the 2 standard deviation band, which is now falling at 0.9 to 1% on the 10-year Treasury.
Okay, and this fits in with, I suppose, what you said earlier about it's really the next 6 months that are going to be quite crucial in terms of pointing to the kind of longer-term direction, isn't it?
The next 6 months to 2 years, there's a lot of cycle work that we try to correlate against the market, and we suspect that a lot of investors are focusing too heavily on what they call geopolitical risk or tail risk. And we sort of know that there's a ton of tail risk and geopolitical risk which could derail the market, but we think the macro markets are going to be the key behind what's going to happen in the next few years or so. So if you take a look at the U.S. business cycle, the U.S. business cycle typically runs in cycles in years of 4 to 6 years is a norm of one U.S. business cycle. We got 2014, which puts us into the 5th year of that cycle. Also, we have midterm election into November 2014. And the maturing of this U.S. business cycle is probably going to reach critical stage probably sometime into the back half of the year, into the early parts of 2014, depending on how speculative we move up on this rally here. The more speculative the rally is, the more aggressive the rally is, the more likely there's going to be some kind of blow-off stage to this particular rally, if we're correct that this is a cyclical recovery versus a structural recovery.
Okay, Peter, thanks very much for that. Can we have a quick look at the Nikkei? I was just going to start by asking you how important the correlation between the U.S. stocks and the Nikkei, how closely are they kind of correlated, and how important is that correlation?
It hasn't correlated at all over the last 20-plus years off of their deflationary cycle. Obviously, if you take a look at the Nikkei 225 chart in 91, we were trading at, what, 27,500, and then we fell pretty dramatically. So we're trading about 12,686 or so. So it has not correlated against the S&P 500. In fact, it's been somewhat inverse correlated using this long-term chart here. Now, what we're a little bit concerned about here is that we track a lot of the flows in the market, and there's two exchange-traded funds that retail investors tend to buy into if they want to play the Japanese equity. And also hedge funds tend to use these vehicles. It's obviously the Japanese web, the EWJs, as well as the Wisdom Tree DXJ. So both of these have exploded in volume. So we suspect that a lot of traders and investors have come into those two exchange-traded funds. But if you take a look at this Nikkei 225 average here, the Nikkei looks like it fell right at the downtrend line going back to the early 1990s here. So that downtrend line is pretty significant, and we touched it. We went right to the 16,000 zone area, and that day when the market reversed, or the Japanese market reversed, that may have been some form of a key reversal day. It looks like this rapid rise and then the rapid decline right at key resistance level at 16,000 would signal to us some form of a correction taking place. So I'm a little bit concerned for some of the retail investors that got caught into that rally last month or 2 months ago in the expectation that there's a structural change taking place in the Nikkei 225. If you just look at that chart, it's still in a structural downtrending environment, but until it gets above that 16,000 area, the dominant trend is still down. We suspect we're probably going to go into range bound between 11,000 and 16,000 over the course of the next year or two on the Nikkei 225.
Okay, so this doesn't represent a structural shift. I mean, I suppose it represents the stimulus that was received by comments from the Bank of Japan and the government and so forth, doesn't it? But technically, it's not actually that significant, as you said. That's potentially what the situation is.
Well, this is the first time that Japan had made a concerted effort on both the part of the Prime Minister as well as the Bank of Japan, or in concert trying to stimulate themselves out of their deflationary cycle. Now, we recognize these deflationary cycles are very, very long and drawn-out process. And now, looking at this chart, it would imply, yes, they made an attempt to try to reinflate. They've made a number of attempts in the past, but this is the first time they had a concerted effort from both sides, both on the political and the monetary side, to try to take them out of this deflationary cycle. We think it's a it's a desperate attempt to do it. Now, it doesn't necessarily mean that it's not going to work, but we don't think it's going to move through 16,000 that quickly. So therefore, we're going to go into a high-level basing effort, probably spanning the next year or possibly 2 years or so, with a very, very choppy trading range. Now, because of that, we're going to monitor the big names in Japan, the Japanese Nikkei, the Sonys, the Honda Motors, the Toyotas, because that's where all the big money managers are probably positioned. If they want to play the Japanese market, and they had to play it given the extent of that 85% rally, they were forced into that call, and then the shorts probably were forced to cover their positions into that sharp rally above that 11,000 zone area. So we suspect that they're monitoring this call very, very carefully, and this pullback, it's going to be very important, because if you take a look at the second chart there, in 2010, we peaked out at 11,408. Look at where the 30-week moving average is. We broke the 10-week moving average approximately at 13,808. We're probably headed into those 2010 peak / the 30-week moving average. And if you look at also on the third chart there, we have the Nikkei 225 with a Fibonacci retracement strategy, which takes us back to November when we were trading at 8,619 and change, and then obviously that rally to 15,942.60, 85% rally. Very, very impressive. Impressive 6-month rally. Look at the negative outside week pattern during May. That was a very, very significant reversal pattern right at the 16,000 or close to the 16,000 downtrend line dating back to early 1990s. And look at how we breached that upper end of that channel on that decline right through, it was at the low 14,000, and how we breached the lower end of the November uptrend channel here. That would imply to us that we're headed into this 50 to 61.8% retracement level, which is probably going to be a very, very key level where these investors are going to they're going to determine whether they're going to hold on to the Japanese market or they're going to exit out those positions. We're getting close, so we're getting into some kind of inflection point, probably into the next month or two.